Welcome to this deep dive into the Celestica Q1 2025 earnings call. We're here to really unpack the essential information for experienced investors like you, getting you the key takeaways without that hours-long call.
Exactly. And today, it's all about Celestica. We'll look at their performance, what's driving it, and importantly, what it might signal going forward.
So let's jump right in. What were the headline numbers? How did they actually do in Q1?
Well, they kicked off the year pretty strong, actually. Revenue came in at $2.65 billion,
Okay.
which was above the high end of their own guidance, so a solid beat there.
And profitability.
Also strong. Adjusted EPS was $1.20, again, better than they expected. And maybe the highlight was the adjusted operating margin.
Yeah.
Hit a record 7.1%.
Wow, 7.1%. Okay. And how did the different parts of the business perform, the CCS and ATS segments?
Yeah, both did well. Both CCS, that's Cloud and Connectivity Solutions, and ATS, Advanced Technology Solutions.
Yeah.
They both outperformed what Celestica had guided for. So pretty positive across the board for the start of the year.
Okay, a strong start then. You mentioned revenue beating expectations. Overall growth was pretty substantial year over year too, wasn't it?
Oh yeah, definitely. Overall revenue jumped 20% compared to Q1 last year.
20%. So what were the main engines behind that?
The big driver was really the CCS segment. That part of the business surged 28%.
28%, okay. And that's the cloud business mostly?
Predominantly, yes. Driven by, well, really robust demand from their hyperscaler customers. They just keep spending.
Right.
And specifically, it was demand for their HPS networking switches, high performance systems. That specific product area grew an incredible 99%.
99%.
Almost doubled.
Almost doubled year over year. It really points to, how critical that networking infrastructure is for AI and cloud buildouts. And Celestica seems well positioned there.
Makes sense. And the other segment, ATS.
ATS also grew, up 5%. That also beat their outlook, mostly thanks to strength in their capital equipment business. Okay, so digging into that CCS segment a bit more, because that seems to be the powerhouse right now. Were all parts of it growing that fast? You mentioned hyperscalers.
Not quite uniformly, no. Within CCS, the communications end market, that revenue rocketed up 87%.
87, wow.
Yeah, again, mostly that HPS networking demand, including them ramping up their new 800G programs. That's a big factor.
Okay, 800G coming online, but what about the enterprise side within CCS?
Ah, right. That was the counterbalance. Enterprise end market revenue actually declined pretty significantly, down 39%.
Down 39. Why the big drop there?
It was actually expected. They flagged it. It's due to a technology transition in an AML compute program they have with one of the major hyperscalers. So a temporary dip related to a specific program shift.
Got it. So sort of a planned pause or transition on that specific program, but the overall hyperscaler trend, especially in networking, is overwhelmingly positive.
Exactly. That strength more than made up for the enterprise dip in CCS.
Okay, that paints a clearer picture of the revenue drivers. Now let's talk profitability. You mentioned that record operating margin. How did the margins stack up overall?
Yeah, they looked quite healthy. Adjusted gross margin improved nicely, up 110 basis points to 11.0%.
11% gross margin. Okay.
Then, as we said, the adjusted operating margin hit that 7.1%, which is up 120 basis points year over year. So good leverage.
And what drove that expansion? Was it just the higher revenue or?
It was a combination, but margin improvement in both segments really helped. In ATS, the margin was 5.0%. That's up 80 basis points.
Okay.
That came mainly from the strong performance in capital equipment we mentioned, but also, interestingly, improved profitability in their A&D aerospace and defense business.
Right. And CCS margins with that huge HPS growth.
That's where you really see the impact.
Right.
CCS segment margin hit 8.0%.
8%. That's quite high for that type of business.
It is. And that was up 120 basis points. It's really down to getting a higher mix of those generally higher margin HPS revenues, plus, good operational execution, keeping costs in line.
Makes sense. Higher value products driving better margins. So strong top line, improving bottom line. What about the overall financial health? Balance sheet, cash flow, that sort of thing.
Looks pretty solid there too. A key metric, adjusted ROIC, return on invested capital, jumped significantly to 31.5%.
Over 30% ROIC, that's impressive. Shows they're using their capital efficiently.
Absolutely. And it's a big improvement. Another positive sign, their inventory actually decreased year over year.
Even with revenue up 20%, that's good management.
Exactly. Shows they're managing working capital well. And free cash flow generation was strong, too, at $94 million for the quarter.
94 million. Solid. And I saw they were buying back stock as well.
They were, quite aggressively, actually. They repurchased $75 million worth of shares during Q1, and then they bought back another $40 million after the quarter ended, so in early Q2. It definitely signals management's confidence and a focus on returning capital to shareholders.
Okay, so the Q1 picture is strong growth, expanding margins, good cash flow, and shareholder returns. What are they projecting going forward? What did the guidance look like?
They provided guidance for Q2 and updated the full year. For the second quarter, they see revenue between $2.575 billion and $2.725 billion.
Which implies?
About 11% growth at the midpoint compared to last year's Q2. So continued solid growth.
And earnings.
Adjusted EPS for Q2 is expected between $1.17 and $1.27. That's a big jump, roughly 36% higher year over year at the midpoint.
36% EPS growth. Wow.
And margin outlook for Q2.
They expect non-GAAP operating margin to be around 7.2% in Q2, so ticking up slightly even from the record Q1.
Okay. And the full year. Did they raise the outlook given the strong start?
They did. They boosted the full year 2025 revenue forecast to $10.85 billion.
Which is what kind of growth for the year?
That implies about 12% growth for the full year now. Okay.
And they also raised the full year non-GAAP adjusted EPS outlook to $5.
$5 EPS for the year? That's a significant target. What about free cash flow for the year?
That outlook they kept steady, still expecting around $350 million in free cash flow for the full year 2025.
Right. So strong momentum expected to continue through the year, it seems. Beyond the numbers, what were some of the key themes or trends management talked about on the call?
Yeah, a few important things came up. First, just reinforcing that the demand from hyperscalers is strong and looks resilient, especially for that networking gear. That's really the core story right now.
Makes sense. Any worries about the macro environment, trade issues?
They definitely acknowledge the uncertainties, particularly around trade policy. That's always a factor. However, they mentioned some temporary exemptions that are currently in place for key data center IT hardware.
Ah, okay. So that provides some near-term clarity.
Exactly. A bit of breathing room. And they also emphasized their global manufacturing footprint gives them flexibility, if they need to shift programs around due to policy changes.
That diversification helps manage risk. What else stood out?
They talked about momentum and winning new programs, specifically mentioned next-gen stuff like 1.6T switching.
1.6 terabits, so the next speed bump.
Yep. And optical transceivers as well. Winning those deals now positions them for the next cycle of growth.
Looking further ahead.
Right. They also expect that enterprise end market, the one that's down to Q1, to start growing again in the second half of the year.
Why the turnaround?
That's when those next generation AML compute programs, the ones causing the transition now, are expected to ramp into full production.
Ah, okay. So the dip is temporary before the next wave hits.
That's the expectation. They also see stabilization and recovery coming in their industrial business, which is part of the ATS segment.
Okay.
And one other strategic point, they decided not to renew a specific program in their A&D business because it was diluting margins.
Ah, trimming lower margin business to boost overall segment profitability.
Precisely. Should help the ATS margin profile going forward. And finally, they just reiterated their commitment to R&D investment, especially in CCS, to stay ahead technologically.
Okay, lots of moving parts, but mostly pointing positive. So if you're an investor looking at Celestica, what's the key context here? What should you really take away from all this?
I think the first thing is just how strong that underlying demand from the hyperscalers appears to be. The Q1 results and the raised guidance really hammer that home.
That seems central, yes.
Second, the mix shift towards that higher margin HPS business is clearly working. It's flowing through to the bottom line and improving overall profitability, which is great to see.
Right, growth and margin expansion.
Exactly. Third, while those macro and trade risks are real, management seems confident they can navigate them, and they didn't back down from their positive outlook.
And the buybacks add to that confidence signal.
For sure. The significant share repurchases tell you management thinks the stock is undervalued and believes in the future performance. Then there's the tech leadership angle, the 800G ramp. The 1.6T wins it, suggests they're well positioned for the next wave of data center upgrades.
So staying relevant in a fast-moving tech space.
Definitely. And finally, don't forget that potential upside from the enterprise segment recovery in the second half. That could provide another leg of growth later in the year.
Okay, that's a great summary of the investor context. Now let's move to our favorite speculative part of the deep dive. And remember, everyone, this is not financial advice, just tossing around some ideas based on the call.
Always the fun part.
Okay, so here's a thought. You see Celestica riding this massive wave of hyperscaler spending, especially on high-speed networking for AI. Their HPS business is booming, 800G is ramping, 1.6T is coming, and that enterprise AI compute business is set to rebound later this year.
Right. Very specific growth drivers.
Exactly. So what if you considered a long position in Celestica itself, but you pair that, maybe hedge it slightly, with a short position in, say, a large semiconductor equipment manufacturer?
Interesting. Why that specific hedge?
Well, the idea is that while Celestica is directly benefiting from this very focused hyperscaler AI build-out capital expenditure, the broader semi-equipment sector might have a more mixed picture. Their demand depends on, memory markets, logic, different end customer cycles that aren't all firing like hyperscaler networking right now.
So isolating Celestica's specific AI infrastructure tailwind while hedging against potentially broader, maybe more uncertain semiconductor capital spending cycles.
Kind of, yeah. You're betting on the concentration of spending that directly benefits Celestica versus maybe a more dispersed or cyclical pattern for some of the big equipment suppliers. It's a way to play Celestica's strength while acknowledging potential wider industry risks. But again, just an idea. You absolutely have to do your own homework here.
It's definitely a plausible angle, focusing on where that capital expenditure is being most intensely directed right now. Makes you think.
Absolutely. Okay, well, that brings us to the end of our deep dive on Celestica's Q1 2025 earnings call. We've hit the key results, dug into the drivers, and looked at the bigger picture for investors.
Hopefully, this gave you a clear, concise rundown of what you need to know.
We hope so. As always, we encourage you to dig deeper yourself. What stood out most to you? What questions remain? Keep researching. Join us next time on Talk Tickers for another deep dive into a crucial earnings report.